Hi guys, Shubh Goel this side. Welcome to my channel Team Trades. And first of all, sorry I was not able to post daily newspaper analysis for today. I was a bit busy today in some of my works. So yeah, I'm here for analysis of a book. I think you can see this. Okay, so it's Fundamental Analysis for Investors by Raghu Palat. It's a very nice book. You can read it. Yeah. So let me explain the module, like how we'll be analyzing these books. I'll be analyzing these books for you guys, chapter wise. So like the very first chapter in this book is intrinsic value, which is a very interesting concept. This book then divides itself into three parts: part 1, part 2, and part 3. Part 1 contains economic analysis, that is, political economic analysis, thus economic cycle, asset bubble. Asset bubble is again a very important concept and will help you know where a bubble is being created. Okay. Second thing is industry analysis. There's just one chapter in this, that is industry analysis only. In this, it tells us what industry should contain, or how can you choose a sector, a proper industry, how can you choose a business where you want to invest. Number 3 is company analysis, which is the most important component in this book. The very first chapter in this company analysis is the management, then the company, the annual report, which is director's report, auditor's report, financial statement, schedule, and notes to accounts. All this is accountancy, pure accountancy. You should understand and know what are some basic accountancy terms, otherwise you won't get this annual report thing. Then there's ratios, a very important concept, again a very important concept in this book, which contains market value, earning, profitability, liquidity, leverage, debt service capacity, asset management, efficiency, margins. All this comes under ratios. So we'll understand what these ratios are. Then there's cash flow. Cash flow is also basically an accounting term only. Cash flow means cash book in a advanced way. You know what is a cash book? Cash book means the cash which is coming into the business and the cash going out of the business. It's only about the cash, it's not about the assets and all. So it's cash flow. We'll understand what this book says about cash flow of a company. Then there's conclusion and fundamental analysis step by step, which is basically notes of this book. Okay, so in preface and acknowledgement and all that, the writer, that i.e. Raghu Palat, just says that don't invest before knowing. Now, don't just put your money into a stock without knowing the business of the company, without analyzing the fundamentals of the company. It's of no use if you're doing that. You won't get good returns. If you even get, by somehow you can get if you're lucky enough, but you will lose them. You won't hold them for a long time. A very important and nice quote I found in this was on page number 11. The art of successful investment lies in the choice of those industries that are most likely to grow in future, and then in identifying the most promising companies in those industries. It just means that you need to find the best industry, then find the best company. The picking the best is the key in markets if you're investing for long terms. In today's terms, it's Reliance, maybe. Yeah, it's they are doing like really good in every field. We'll do that, we'll analyze them. Then there's something, Belgium Graham adds. Then this, it's about 2000's crash, 2002, 2008, 2002's bubble, then the burst of the Lehman crisis, 2008 crisis, then 1992 Harshad Scam crisis, 2000 I think three. It was there was nothing about the Ketan Parekh scam. So and then there's this introduction, acknowledgement first. Sorry, then the introduction. Yeah, it's the same. 1992's. Then Karnataka Bell Bearings. It was a company thing. Yeah. There's another quote I liked very much in this book was no one should buy without knowing as much as possible about that issues it. So if you're buying a company's stock, analyze it deeply, like deeply. You can't leave a single information about the company, whether it's current information or whether it's the fundamental information. Now, what's the difference between these two? These two are basically different in many ways. So current information impacts the prices of a stock or a company in the current market. So let's say X, this a company named X, and its price is 100. Current market price is 100. A news comes up that says government is increasing 5% margins or the 5% tax slab or anything which impacts the company in the next quarter. So if a company is being impacted for only the next quarter, this is a current news. This would impact the company shortly. If the government says that no, we'll be raising the amount for 5 years or maybe 10 years. No, 10 years it's not possible because in every 5 years maybe the government can change, maybe it can be the same. But after 5 years, government like it can put a ceiling of 5 years maybe. So let's say if it puts a ceiling of 5 years, then it's a fundamental change in the company because that would be dealt by the company in the long term, right? The company would face losses or maybe things in long terms. So that's the fundamental change in a company. So you should know what's the difference between a current news and a fundamental news. Alright. So what you should like see while buying a company, in the introduction part only the writer says information about the economy, which is the very important thing because where the company is being established and where it trades, it's very important that you analyze that economy particularly. Then government policy and taxation, yeah, it's another very important thing. Then there's industry, we just talked about the industry. Then it's management, performance, and it's sales can change, but in this what I feel is, what I presume from this sales is that this means sales in the future terms. So after 4 years or 5 years, how much the sale would be for the company. So how can we analyze that? By looking for the market, like how big is the market, by reading the director's reports or director's interview, so that we can see that what's the vision for the director in the company, like are they even interested in expanding the company or they're not. That's a major reason why PSU stocks don't rise up, because investors believe that their directors are not concerned with the company. So yeah. So second is sale, like director's vision, and the third is the focus of the company, particularly the actions directors take. So we can see that if a director has said something in the past, is it being implemented in the current situation or not? If they are not implementing it, why not? If like you need to understand the director's mentality and the company's mentality even while choosing a stock. When you say like you wanna know the future of the company, then you need to read the directors very importantly. Recently, for example, Kotak Mahindra bank's share was on a like in a very bad condition. It just fell off. What was the reason? Because director just resigned, which impacted the company a lot. And there was a rumor that the director which resigned, or the manager, yet the CEO, joined the federal bank. So the stock of Federal Bank was rising rapidly. I feel that's the thing about the management. Management of a company is the most important thing of a company. It's the most important thing. Like it's the human asset of a company. So you can't ignore the management thing. Okay, let's move ahead. Media too. The writer says, I would insist that the serious investor should read at least one good financial paper every day and two magazines a month. So to give him well informed, you should be well informed too. That's why I'm making these videos for you guys, so that you don't need to read financial papers daily. You can just watch my videos and can like gain information through it. Two magazines a month, okay, I'll try doing it too. For you guys, of course. Okay, so here comes our first chapter, that is fundamental analysis, the search for intrinsic value. Okay, guys. Now let us understand what is intrinsic value. Intrinsic value is the core value or the real value of any marketable security. It should be perceived on the risks and the year-on-year return that security provides. Okay, what does that mean? That intrinsic value is the core value. It's the value a company deserves. In very simple terms, it's the valuation of the stock of a company. Like each and every single stock of a company is the intrinsic value for it. And now, how can we calculate it? So we calculated on the year-on-year returns by adding the risks on it. Okay, so what does that mean? There's a year-on-year return on every stock. It can be minus and plus in any numericals. You need to subtract the risk out of it. Okay, so calculation this book tells us is dividend received, that is year on year return. Okay, now it is perceived dividend received. To calculate how we can perceive the dividend for a company, how can we perceive it? From past records, from profits of the company. You see, if any company makes profits, its stock just rises. Why? What's the impact? It's just that like investors expect that this company would give them some dividend out of it. Okay, now what is dividend? Dividend is basically the share of each and every stakeholder in the company, which is to be provided out of the profit. So let's say there's a company named X again. Okay, now X has a profit of 100 rupees. Okay, it's the net profit. Now there's some difference between gross profit and net profit, even we'll discuss it later. So there's the net profit of the company is rupees 100. Okay, so the company can provide dividend to its stakeholders on rupees 100. These dividends first are provided to the preference shareholders or the promoters holdings, we can see that. And secondly, it is being provided to stakeholders, to the stockholders. That's why if the company makes profit, then people do invest in it. Okay, it's for the dividend basically. And stock markets were initially not for trading and all. No, they were for dividends. If you're investing in a company, it should provide some dividends, so that's the return out of it. And you please understand that it's my own perception about the markets. That is, if you're investing in, let's say, company X, you're investing 100 rupees in it. Now you should want a 14% return off it. So you should invest in a company, those 100 rupees, you should invest in a company which is providing dividend to you. Because ultimately, dividend works. Dividend is just like interest rates. Why not considering it as interest? If the company is providing you dividend on your equity shares, then why not? And the price rises. So you should invest in companies which provide dividend. Yes, you should do that because they're providing you with dividends, and the price of stock is rising. So it's a win-win situation. Yeah. So you should analyze that if a company's profits will rise or not. It's a game of profits again. Business is a game of profit. In any business, it's a game of profit. So you should see whether they're making profits or not. Okay. So this book tells us to calculate this on perceived dividend received for years plus value of security after years. It's the same. So the dividend you perceive, let's say for 3 years, and value of the equity share after 3 years, you should add those, divide by 100 plus expected rate of return. Now what is rate of return? Rate of return is the percent you are getting back out of your investment. Okay, so that is rate of return. Now 100 plus rate of return upon 100. Okay, then the power would be number of years. So if you're investing in a company for 3 years, that is 100 plus expected rate of return upon 100 plus 100 plus expected rate of return upon 100 का whole square plus 100 plus expected rate of return upon 100 का whole cube. That's the thing. So this is basically search for intrinsic value. Okay, if I read some lines from this book, that is, as the return to shareholder is in form of dividends, under strict fundamental analysis, the present value of the future dividend discounts on the basis of its perceived safety or risk is its intrinsic value. The intrinsic value is based on dividend because that is what a shareholder or investor receives from a company and not on the earning per share of the company. Even this says this, that you should not see earning per share of the company. Of course, you can see it as a ratio, but not only on the basis of that you should invest in a company. You should see other things too. Right. So this was the first chapter of this book. Yeah. Okay. So there's some another thing in the same chapter, that is efficient market theory. Now I'm not going to make it all understand you guys, but I'll read some lines out of it which I found interesting and useful too. The most important factor in the fundamental analysis is information about the economy, information about the industry and the company itself. Any information that can affect the growth and profitability of the company, and it is because of the fundamental analysis is broken into 3 distinct parts. Now it says that information is the key in markets. If you are well informed, you can conquer the markets easily. So yeah, but it says that information is being broken into 3 parts. Okay, 3 parts. You can see my fingers, 3 parts. So what are those 3 distinct parts? The first is economy. Okay, second is the industry within which the company operates, and the third one is the company itself. So what is the economy? We have a whole part of the book on this, which contain 3 chapters, 3 important chapters. We will be analyzing a chapter tomorrow, that is politico-economic analysis, Politico-economic analysis is going to be an interesting chapter. I can see it's huge too. Yeah, of course. Okay, we'll do analysis on this tomorrow. Thank you guys. Good night.